Welcome to this explainer. Today, we're dissecting what is, frankly, a fascinating state of deep market indecision and analyzing the metrics that have Bitcoin pinned in a historic squeeze. Look, I'm absolutely thrilled to walk you through this because what we're looking at right now is extreme market compression. And just to be clear right up front, we aren't here to predict prices or try to tell you where the market's going to end up tomorrow. Instead, we're keeping it strictly to the data. We're delivering a measured analytical breakdown, and we are going to give equal weight to both the bull and the bear cases. We'll explore exactly what this massive compression is really telling us about institutional fatigue, regulatory anxiety, and the potential for new capital rotation. Here is our quick roadmap for today. We'll kick things off with the illusion of calm, explore the forces behind the freeze, and then weigh the bull case directly against the bear case. Finally, we'll hit the key metrics to watch and wrap up with the reality of risk. All right, Section 1, the illusion of calm, a market frohin. To really put this illusion into perspective, you have to look at the price action. Despite sitting at a very substantial $64,363, Bitcoin has barely budged. We're talking about a negative 0.6% change over the past week and a really modest positive 1.6% over the past month. For an asset that is historically famous for its massive double-digit swings, this incredibly tight trading range is highly unusual. It signals deep structural market indecision. Honestly, it's like a tightly coiled physical spring, just sitting there, waiting for a catalyst to make it snap. And this stagnation, it's totally reflected in the volume. Total 24-hour crypto market volume is sitting at just $55.4 billion. Now that might sound like a lot, but remember, this is across a massive $2.28 trillion total market capitalization. To realize how incredibly quiet that is, just consider that during peak bull market frenzies, we've easily seen daily volumes triple that number. Right now, across the board, traders are just sitting on their hands. There's a distinct lack of direction, and market participants are basically unwilling to place large directional bets until they get some clarity. And this next metric brilliantly illustrates where the capital is actually hiding. Bitcoin dominance stands at a highly consolidated 56.65%. So what's this telling us? It means that during this quiet period, we are seeing a major flight to safety narrative playing out within the crypto ecosystem itself. Capital is pulling back from the riskier fringes and consolidating right into the market leader. Traders are seeking out this safety of the largest tokens, which is essentially leaving major altcoins to bleed value during this freeze. While Bitcoin treaded water with that modest 1.6% gain over a 30-day window, major assets like Solana and XRP took a hit, seeing notable declines of 10% and 7% respectively. It's a very clear rotation away from perceived risk. Moving on to Section 2. Forces behind the freeze. Let's look at the three major headwinds. Based on the source material, there are three specific headwinds creating this perfectly balanced tug-of-war that's preventing any major directional movement. We've got regulatory uncertainty, institutional exhaustion, and a brewing security crisis. Let's zoom in on how these are impacting market sentiment. So, on the institutional front, that massive initial rush we saw earlier this year, it seems to be giving way to a much more cautious wait-and-see approach. Funds have reportedly reduced their holdings by 10%, leading to some analysis that the quote-unquote Bitcoin treasury trade is breaking. Plus, JP Morgan notes that inflows into the hyperliquid ETF, which is a really key proxy for hot money institutional interest, have essentially stalled out as competition mounts. Add to that a genuine crisis of confidence and security. The high-profile cold card hardware wallet exploit recently resulted in the theft of 64 Bitcoin and 200 Ethereum. And following that, reports emerged of a Bitcoin red team finding 85 critical flaws across 390 open-source repositories. I mean, that is certainly not what conservative capital wants to hear about a decentralized asset, right? It directly shakes one of the core tenets of the entire space, self-custody. Now, weighing the scales of justice equally, let's pivot. Let's examine the exact catalysts that could break this stalemate in either direction. Remember, we aren't in the business of predicting prices here. We are trying to understand the mechanics of how this low volatility environment could resolve into a major directional trend, whether that's upwards or downwards. Section 3, the bull case, the coiled spring theory. A major upside catalyst right now is a theory of capital rotation. Major tech stocks like SanDisk and Western Digital recently took a 10% hit. The big question circulating in the market is whether capital is finally beginning to rotate away from those red-hot AI winners and into crypto. If large funds start to perceive the AI trade as overextended, Bitcoin could absolutely become the prime beneficiary for the next major growth narrative. Furthermore, regulatory developments could act as a massive tailwind. The Crypto Clarity Act is currently under review by the White House, with Senator Loomis actively urging the Senate to act before their August recess. If this act passes favorably, it provides the exact, formalized rulebook that conservative, large-scale institutions need to enter the market en masse. That could potentially unleash a wave of demand that totally dwarfs previous cycles. A decisive breakout above the recent trading range, supported by strong volume and a return of consistent ETF inflows, would be the key signals validating this bullish coiled spring theory. But looking at Section 4, we have to consider the bear case, stealth distribution. Looking objectively at downside risks, faltering institutional interest is a glaring red flag for the bear scenario. We previously noted the reports of funds dropping holdings by 10% and that Treasury trades supposedly breaking. Well, if the institutional bid that brought us this far is genuinely fading and ETF inflows remain flat or negative, there simply may not be enough new buyers stepping in to absorb sustained selling pressure. If that happens, a structural drop below the key psychological support level of $60,000 becomes a very real, mathematically grounded threat. And we just cannot ignore the permanent damage to the self-custody ethos caused by recent exploits and the horrifying rise in violent, real-world wrench attacks. These attacks recently accounted for $30 million in stolen assets. These security crises risk scaring away a significant cohort of both retail and institutional investors who might just conclude the space is simply too risky to navigate right now. Combine this with the potential for an unfavorable regulatory outcome, like the Clarity Act being killed or delayed indefinitely, and we've got a recipe for a rapid, sharp sell-off. Increased exchange inflows from holders moving their coins to sell would be the definitive confirmation of this bear thesis. Section 5. Key metrics to watch. Let's look at the dashboard. Here is your chronological watch list. First, keep a close eye on weekly ETF flows. We're looking for a reversal of the currently stalled trend. Multi-hundred million dollar net inflows would signal a bullish breakout, while continued outflows validate the bear case. Second, watch that impending August recess deadline for the Crypto Clarity Act. Any news from the White House or Senate on this is a critical near-term catalyst. Finally, track NASDAQ and AI-related tech stock performance over the coming quarter to see if that speculative capital rotation theory actually holds water. And as for Bitcoin dominance, it can actually act as a live fear gauge for us right now. Sitting at 56.65%, if it climbs even higher, it means fear persists and capital continues to seek shelter. However, if this number falls sharply, it's a massive risk-on signal for the whole market. It indicates that capital finally feels confident enough to flow back out into more speculative altcoins. Finally, Section 6, the reality of risk. We have to acknowledge the unknowns. The reality is that this entire analysis assumes the low volatility environment resolves into a major directional trend. But you know what? The market could simply drift sideways for months, frustrating both bulls and bears equally. Furthermore, a sudden macroeconomic shock or an unpredictable geopolitical event could completely override this entire crypto-native thesis, sending prices moving for totally unrelated reasons. And of course, the narrative of capital rotating from AI into crypto is, for now, based on highly speculative and limited data. Honestly, it may never materialize. So as we watch this historically low volatility environment play out, the ultimate question remains. When this stalemate finally breaks, will an AI-driven wave of capital unleash a historic bull run? Or will an institutional retreat confirm a devastating stealth distribution? The clock is ticking, and the data is waiting. Thank you for joining me for this explainer. Keep analyzing, and I'll see you next time.